for you. Let's, we'll come back and look at some individual names, etc. in just a bit from now. Rajiv Batra is with us as head of Asia and co-head of Global Emerging Markets Equity Strategy at JPMorgan. Rajiv, good morning. Welcome back. I suspect this is the last conversation of the year, at least.
Morning, Prashant.
And then we will be 2026. So, a tough year, right, Rajiv? But I guess after a tough year, maybe comes a slightly easier year. Not easy or a great year, but maybe an easier year. You think that's the broader kind of view out there as well? You think that'll be the case?
That's a very good phrase. When things get tough get going, and that's what Indian equities is all about. In a tough year also, we still try to get to the new highest level over there and didn't give a big drawdowns. Yeah, relative term, we are underperformer, 25% relative to EM on a 12-month basis. But on absolute term, we still protected investor capital who still parked their money and stayed with India overall. Yeah, going into next year looks pretty exciting to us. The market is getting more worried about trade deals or the global AI environment. What keeps us excited is that policy is working at forefront, be it on the monetary term, fiscal term, and most exciting is on the regulatory easing front. We are also seeing discussions on FDI, be it in insurance and nuclear sector. So all this is coming as a music to the ears of long-term investors, who exactly want India to work on policies, reforms, and regulatory easing. And that's what India policymakers are rightly addressing at this juncture.
How is this rupee weakness playing out? You can look at it. I mean, if you buy now, you're buying at a better level. But I mean, if it continues to slide, then you are at a loss. You lose if you put in money. So I mean, is there a level of anxiety there among foreign investors?
Obviously, there is some loss of confidence, and we can see in terms of flows also, net outflows from India equities, India debt market. Month to date is close to $1.6 billion. That shows up in form of profit booking in some of the trade ideas also from investors. Again, I will say one environment is not conducive for a risk on trade. We can see what's happening in the dollar environment. People are nervous this week because we have 11th central bank meeting, data points coming from US, job CPI, then China. And this is the reason why it's a risk-off environment, and that's where rupee is reacting. But beyond that, I will say rupee depreciation is inevitable and desirable too, taking into account the macro environment where you not only need to offset the differentials on US tariff, but also needs to make Chinese imports expensive. To discourage importers importing from China. So I do believe it's a calibrated move to depreciate rupee to keep economic growth going and not hurting your exporter in this environment. Beyond that, I will say we should not worry much about economic effect because inflation is already low. External debt levels are also low. So the only hurt which is there is on the equity investor confidence at this juncture.
And that's a big question, Rajiv, isn't it? Good morning. Great to have you in and wish you season's greetings. And I was exactly coming to that, this foreign investor confidence, right? And it's fine. Domestic flows have been so resilient that we've managed to hold the market on our own, which is a huge achievement. But we also realize that foreign participation is important if this market is to get its mojo back. Now, looking at the data out of your report, I think you folks are expecting 13% earnings growth in 2026 calendar year and 14% in 2027 calendar year. Now, will 13 to 14% earnings growth, along with a depreciating currency and the tax that we have here in India, will it still be enough to get the foreigners back when they're getting attractive bargains in deep tech, AI, etc. in the rest of the Asian region?
Thanks, Rupee, for having me, and happy holidays for coming weeks also to you.
Thank you.
Again, yeah, the base case does not take into account a massive rupee depreciation, which has just started overall, but a much more calibrated one, which keeps you in the range of around 81, 89 to 91 or max 92 over there. That is still welcome because it also gives entry point to the new investors also who think that this is the right level. You are right at the trough in terms of an INR and you get a good entry point per se. But any depreciation beyond that, will be definitely become a huge huge amount of a concern pertaining to investors who have been long into India, maybe for not just a decade, but 2 or 3. But if it's purely coming to the growth perspective, saying that rupee remain at a current juncture, and despite that you get 13% earning growth, it will still be higher than what you are getting in AI part of the world. Remember, AI still is a hope trade. It has not translated into revenue so far. Like altogether, globally, if you look at the AI revenue, it's only $50 billion on a lot of capex that is being done. Earning growth is very different story. That's where if doubts start arising on AI trade, on earning growth term, that's where India emerges as a safer haven, which is still offering you a 12 to 13 weeks, or you can say anemic from our own history side, but quite decent and good compared to an environment what other countries or region are. And it's also important to remember, again, entry point over here. India is not trading at now 100% premium to emerging market. We are trading at a 50% premium only. So valuation gap has narrowed. And when you start your book at the start of the year, you have a brave decisions to make. The brave decision is, will you buy the markets and the play which are already up 80-90% last year, or you will look into the market that is giving you some value and a hope of a growth coming back. And that's where India fits the bill right now when you enter into next year as one of the big 4 emerging markets.
Hi Rajiv, good morning. Good to hear your thoughts as always. You're sounding a little bit more optimistic on 2026 from the time we last spoke. So that's heartening to hear, because otherwise our portfolios haven't done much just in the near term. Talking about AI, I have a 2-part question. One is on the global AI trade. Do you think that's peaking out? I wouldn't go as far to talk about, term it as a bubble. But do you think that's some signs of it peaking out? And you'll still continue with your underweight stance on tech, I think so. And that index actually is showing signs of coming to life. However, growth is still going to be very, very tepid. So how you all placed out there? Global AI and Indian tech.
Yeah. So in terms of an AI at an Asia level, we are neutral on that particular theme. We are no longer overweight on that theme, and that means we are even neutral to marginal underweight on Taiwan, which is heart of that particular theme. Our bigger concern is we think right now AI lacks moat. That's a key thing. Like, is it your AGI or it is your commodity, like your electricity? If it is a commodities, then definitely it will be more difficult to monetize. And that brings me to the next point, monetization. If you take all revenue, circular, direct subscription into account, there is only $50 billion revenue to support, on which there could be $650 billion capex next year and could be $5 trillion capex in the matter of next 5 to 6 years over there. But if revenue is not coming, monetizations is not coming, then the value does not lie on the AI generator side. The value lies on the use case side. So that's where our concern is, when adoption will come at a faster pace, how it will monetize. So that keeps us on the sideline, and you can say neutral on overall Asia IT sector, and even underweight on India IT. Coming to India IT, our bigger concern is, like, even though they are now started rebounding from September level, good 13-14% odd up, but year to date it is still down 15%, and the bigger concern still lies that valuations are not that dirt cheap enough to even become a neutral kind of a case. Coming back to the growth, 12-month perspective, trailing terms, which is in the bag, it's still very anemic, 2 to 4% only. So that makes the whole IT sector PEG ratio quite uninvestable. You need close to around 10 to 12% kind of an earning growth. That makes a PEG ratio less than 2 for Indian IT. And that will bring the case back for the Indian IT sector. For now, it's too early, according to us, to considering all the AI-related disruptions, valuation expensive, and consensus still not significantly underweight yet. That keeps us at a bay on India IT sector.
Okay, that's India IT. So Rajiv, then leave us with your best themes here in India. You're clearly very optimistic on the market, and it's good to hear that. We've been through a rough patch. But as you expect the market to revive, earnings to revive, foreign participation to revive, what would be your, say, top 2 or 3 themes here in India?
Definitely, number one, domestic demand. That's the theme we need to go in because we have a tailwinds of policy easing. More is yet to come. 4 state elections, so social welfareism will continue on that path. premiumization has been in a play. So I will stick with the domestic demand. And in domestic demand, I will say financializations of saving, premiumization, CapEx transition from older CapEx to the newer one, that is your EMS, robotics, defense. That's the one important to watch. And how we are playing at a sectoral term, materials, financials, and consumer discretionary. So these are the three ways we are playing it. And yes, not just India, global equities going into next year, JPMorgan is very bullish.
All right, Rajiv, what about on consumption? That's been a theme you're like, right? Discretionary is still over staples, or, if you're allocating fresh money, what would the proportion be in discretionary and staples, which have actually been rank underperformers? And some of those companies are very high quality companies.
Yeah. So in terms of a discretionary investor, rather than making a broad jig sector call, we will say we are overweight on both discretionary and staples. But within staple, the preference is for food and beverage over HPC. And in case of a discretionary, the focus is more on auto, your QCs, retailer. These are the buckets which we like.
Yeah, no, absolutely. By the way, I just want to make a quick mention that market breadth is now, it may be a little early still to look at market breadth and things start to settle, but 15 minutes in, right? It's 2:1 in favor of declines right now. So 1,700 stocks lower and about 850 stocks are higher. And Eternal and Swiggy are down 3% and 2% respectively. We had a discussion with the Bernstein analyst, and the question is whether, there is a bit of a war brewing in terms of who's going to outspend to kind of regain, especially from a Swiggy perspective, to try and regain market share. So in that sense, everybody's sitting on a lot of cash. Some raised recently, some raised earlier. BSE is down 2%. BSE, by the way, is the number 3 volume-led loser right now. And by the way, this comes after yesterday's sharp cut as well. BSE was down about 3% yesterday. So that's about 5% in 2 days. High on Friday was 2750, and it's come down to under 2600 now. So that is Bombay Stock Exchange. Axis Bank is down, full 2.5% this morning, 1253. There is Transformers and Rectifiers had a very sharp move from 240 levels to about 300, 315 in 2 days. It's giving back some. And so it goes GMDC, BHEL, Capillary, which is a recent listing, Corona, which listed yesterday, which is a formulations pharma company, is down about 2%, had a very good 30% kind of pop on listing day. So yeah, I mean, it's, a lot happening, but it's more down than up. And of course, I guess you guys pointed out Meesho, right?
Meesho is the only one.
Meesho is up
defying
9%.
gravity. Yeah.
And we had a quick view coming in from Karan this morning.
Yeah.
So Meesho is 185, 186 right now, and on humongous volumes right now, mind you. And by the way, a number 2 volume-led gainer is Shakti Pumps, which is, definitely displaying some Shakti because it's come up from, 550 levels 4 days back to about 780. So had a painful, almost 50% decline from the highs, and is now coming back on the back of some orders, etc. they've got recently. Wakefit is another one, which is up 3.5%. So that's Wakefit, recent listing. Yesterday's listing, by the way, Wakefit. And Iron Exchange is up 8%. Iron Exchange also, by the way, the recent low was 330. It's moved up 100 rupees in a few trading sessions. So that is, some of what we are seeing out there at this point in time. I think we had Chambal Fertilizer, as Mitesh has called. Chambal is up about 2.5%, 3%. Actually, all these fertilizer companies, right? Look at Chambal, look at Paradeep, and Paradeep, of course, non-urea. Fact, that is fertilizer, Travancore, 6%, and a bunch more on the fertilizer side, which are doing very well.
By the way, just pointing out, Axis Bank is seeing some very decisive selling this morning. Yeah, it's down about 3% right now. And the selling on the others, while Meesho is rising, going to the skies, the others, Swiggy and Zomato, continue to be under pressure.
And just one more stock, BSE. Yesterday, the stock was under pressure. And today
5%
as well,
in 2 days.
Yeah, it's, and currently it's at the low point of the day as well. I don't know whether the street is sniffing something, but a stock that was 3,000 rupees just a few days ago, that's come down to around 2,600. We'll keep an eye on it.
60.
This is a SEBI meet, right?
Yeah, I think it's on 18th, I think. There's a SEBI meeting, a board meeting, and some chatter that we reported, by the way, that SEBI is essentially looking at exploring sort of defining eligibility criteria to access F&O markets. So will this board meeting take it up? Will there be a discussion paper? We don't know, but I mean, I can't think of anything else on the back of which BSE is correcting, unless there is something else. But there you go, 2,600 on BSE. Arvind, fashions is what we want to focus on. Rajiv, by the way, if you're still there, thank you very much for joining us. Good speaking with you. Wishing you a fantastic 2025 and New Year, and see you in the new one. Thank you.
Thanks, Prashant.